Hi everyone, my name is Alyssa Pena, and today I'll be explaining the SEC administrative proceeding, file number 320446, involving William G. Steele of Sealed Air Corp. So before we get started, I just have a quick disclaimer. The purpose of this presentation is to observe the public filings surrounding and relating to an individual CPA that has been sanctioned by the SEC or another state board of accountancy. Using public filings, I am attempting to gain a deeper understanding of why the person in question made the decision they did so that I can avoid similar pitfalls as I begin my career in public accounting. This presentation will also include assumptions to help gain a better understanding of why the individual made the decision that they did. So the presentation today will be broken up into 4 parts, starting with general information, then going to my assumptions and takeaways. So I'm going to go ahead and get started with general information regarding this proceeding. So this case mainly has to do with William Gregory Steele. At the time of this case, he was 59. This case was proceeded in 2021. Steele had been licensed in the state of North Carolina since 2006 and had been employed as Sealed Air's CAO in 2013 and was promoted to CFO in 2017. Very closely related parties in this issue were 3 partners from EY, as well as EY, the company itself. James Herring, James A. Young, and Kurt Falkman. James Herring was the partner in charge of this engagement, while Young and Falkman were former partners. All of this is public information taken directly from the SEC filing I mentioned before, as well as the SEC filing number 320447 against EY and partners. So just some more background on Steele. All of this information I did take directly from LinkedIn. So he received his bachelor's in accounting from the University of Cincinnati in 1983. As far as the SEC filing is concerned, he was employed as Sealed Air's CFO. Sealed Air is a company that does deal with a number of packaging products commonly used in supply chain operations. Before his position at Sealed Air, he was employed as an auditor at a public accounting firm and held various internal auditing positions, including Vice President of Internal Audit at Goodrich and Vice President of Finance at United Technologies, both companies having to do with the field of technology. On his LinkedIn, there is a 25-year gap from the time that he graduated in 1983 to his earliest professional experience at Goodrich. And I can only assume that he was working his way up to VP, meaning he has extensive experience in the accounting field. So now we'll go ahead and go to the actual incident. So here I've taken a direct quote from the SEC filing describing the case, but for the purposes of this presentation, I'm going to paraphrase. So the SEC is bringing this case against William G. Steele regarding the issues in connection with the selection process and appointment of an accounting firm to serve as an independent auditor of Sealed Air's financial statements. The main issue in this case was a lack of independence being between the CFO, which was Steele, and the auditors for Sealed Air's financial statements, Ernst & Young. So Steele provided EY's auditing partners with confidential bid proposals from the 3 audit firms in lottery for the audit engagement, and the names of these 3 firms not being public information, as well as the audit committee presentation materials and draft 8Ks announcing EY as the winner of the bid before the bidding process was complete. This was misleading to Sealed Air staff, audit committee, and investors who had the impression that the bidding process was competitive and fair, which was the statement released to the company and the public. So here I also have a direct quote from the SEC case filing involving EY and the 3 partners. Here it touches on the issue of independence, leading to the conclusion that EY could not have conducted its audit impartially with objectivity and independence of fact and appearance. So now I'll go ahead and get into the aftermath and punishment. Quick disclaimer, all of this is paraphrased directly from the SEC case filings regarding Steele and EY. So Steele did violate sections 4C of the Exchange Act of 1983 when he willfully aided EY in violating sections 13A and 14A. Section 13A, which has to do with the accuracy of public company filings, like Sealed Air's 10K and 8K. Thinking as an investor in a company, you wouldn't want to hear that the financial statement audits are misleading, because it's really the only thing you can analyze and rely on to see the business's financial and business status. Um, and Section 14A, which is having to do with false or misleading information in proxy statements sent to shareholders. Sealed Air did tell everyone that the bidding process was competitive and fair, when in actuality it was not. So this rule's mitigating that risk. And finally, Rule 102E, Section 1, Paragraph 3 of the Commission Rules of Practicing, having to do with professional conduct. So both parties failed to ensure auditor independence and misled investors, which is considered improper professional conduct. So as far as firm policies do go, I am sure that Steele violated Sealed Air's employee handbook, which should include sections and bylaws regarding independence and professional conduct during the auditing process. Not to mention that Steele himself was a practicing CPA at the time. He violated AICPA's code of conduct having to do with independence and professionalism. And as soon as Sealed Air found out about Steele's behavior, they terminated his employment in June of 2019. Shortly thereafter, Sealed Air did terminate its audit engagement with EY in August of that same year. So for punishment from the SEC, Steele did get corrections, including a cease and desist order, as well as a $51,000 fine, and a suspension from practicing as an accountant before the SEC for 3 years. EY and the involved parties were also served with cease and desist orders and monetary fines. EY was ordered to pay $10 million directly to the SEC, and partners were fined a total of $90,000. James Herring, the engagement partner in charge, being fined the most at $50,000. This is also on the SEC filings as well. So Steele also faced penalties directly from the state Board of Accountancy for North Carolina, which is where he was practicing. Here I have a direct quote from the incident statement from North Carolina. And for the purpose of the presentation, I'm going to summarize. So North Carolina revoked Steele's license and ability to practice as a CPA for 2 years, which was reinstated and is currently active in 2025. So after these events, like I previously mentioned, Steele no longer works for Sealed Air or any of its affiliates. And I do apologize, but I could not find any information on his current whereabouts or any concurrent employment after the case, except for his North Carolina CPA license being active. So I can only assume that he's practicing somewhere in that state. So we're going to go ahead and move on to the assumptions and takeaways. Let's see. So as far as any reasoning and rationale behind Steele's decision goes, I can only assume that he had monetary gain as an incentive. The SEC case stated that Steele received a bonus of $26,000 tied directly to this manipulated RPF or RFP, request for proposal. I personally believe that breaking the law is worth more than $26,000. So I would like to assume that there were external pressures, like possible promotions or bribes from EY, but nothing of the sort was reported in the SEC filings or found after the investigations. For the side of EY, there was no mention of any monetary benefit for any of the partners in any of the filings, which I also find very strange, and I can only assume they did this to receive benefits in other ways. So I believe this whole situation could have been avoided if each party had acted objectively and ethically by either reporting any suspicious activities like bribes or the release of any private information that you should not have access to. There were many violations of fiduciary duties on both the part of Steele and EY partners. They misled their respective companies and the shareholders, and I personally feel that neither of the parties received a harsh enough punishment. They all had to take the CPA exam. They all were well aware of the independent standards of the AICPA and had to have been aware that their independent standards were in place and that they violated major ethical principles. So no matter what position they could have been in, I think all experienced CPAs should and must know how to make correct decisions when it comes to independence. Um, I honestly think they all should have been mandated to take corrective courses, gotten their licenses revoked, even been fined more monetarily, or at least have their licenses revoked for a longer period of time than 3 years. But since they decided to conduct business unfairly, it's only fair that they be correctly punished. Once again, I do want to reiterate that all of the information that I used for this presentation was from government websites, directly from the SEC, as well as public websites like LinkedIn. And that's my presentation. Thank you.